my main focus point today is about the Japanese bond market and how it could precipitate another unwind of the yen carry trade that we saw back in July of last year. And what you're seeing is the demand for 40-year JGB. So when you hear JGB, that's Japanese government bond, JGBs, okay? The demand dropped to the weakest level since July of last year. And the 40-year government bond hit an all-time high of 3.69% on Thursday and was trading at 3.3%. Last trading about 3.3%. That's up 70 basis points so far this year. And the 30-year bond is up about 60 basis points on the year. Not far from an all-time high. And why this is impactful is because this is how the yen carry trade works. You borrow in Japan, where rates are very low. They typically were, around 1% or so, and there's some sort of spread above that. You might borrow at 1, 2, 3%, something like that. And then you go invest in higher yielding markets, especially the U.S. market, especially now with the Fed funds rate at 4.25-ish in that range. And obviously you can invest in equities, which they also do, and the returns over the past decade plus have, been better than 10%. And so that has been a trading strategy that not just Japanese have deployed, but hedge funds and different types of funds around the world have embarked on for a long time. Remember, because the Japanese central bank has been keeping rates near zero pinned at zero for decades now. And so the fact that they're raising rates because of inflation there is starting to upset that trade. Now, there's still a gap in how much, the yield between U.S. bonds and Japanese treasury bonds, but it's certainly shrinking by a large amount. And the yen is also starting to strengthen against the dollar. It's up about 8% this year. So that is another aspect that's pouring fuel on the fire. Because what these investors were getting were not only a spread between what they were paying in Japan and by borrowing, and then what they're getting on their investments, but they were also getting appreciation in the dollar, for example. But now that is reversing, and that is shrinking the overall gains and a lot of times turning that negative. And so when you're paying 2, 3, 4%, but you're only getting maybe 1 or 2 or maybe even negative, that pairs trade doesn't work out very well. And this isn't just about US stocks, it's about other countries as well. Japan is the world's second largest creditor. So not only are they buying US stocks and US treasuries, but they're buying European sovereign debt and equities as well. And so the steepening of the yield curve in the Japanese market is causing many of those traders to unwind their positions. Now, it's not as stark and dramatic as it was in July, but a lot of this is very consistent. And that's why you're seeing a consistent rise in the yen, because what they're doing is they're selling, say, dollar assets. They're bringing and they're taking those dollars and they're turning them back into yen. And then they're selling their dollar, buying yen, and taking that yen and paying back the loan. So that is a big part of why you see the yen strengthening versus the dollar. And then you add on top of this the policy of the United States now, which is to rebalance global trade. And part of that is to weaken the dollar. They don't really want they might say they want a strong dollar, but in reality, they don't. They don't want a strong dollar. And so while our rates are no longer really dropping, they are going up. A lot of the reasons they're going up is because these investors in these carry trade investors are actually selling their treasuries. A large chunk of foreign US holdings is concentrated in equities, about 18.5 trillion versus 7.2 trillion of treasuries. So this is not just a problem for treasuries. It's also a problem for equities as well. Because as maybe they lose faith, maybe they're not getting the backing or the tailwind, of a stronger dollar. If they're not getting that, it suddenly becomes less appealing. And once again, if you have an administration that's more hostile to a stronger dollar and foreign investors, for example, this is more likely to be just a consistent kind of sucking sound out of US assets.